mortgage modifications are something that have been around for a very long time. Ever since the beginning of mortgages, there's been ways to rework the deal that you have with your bank to lower payments and make your mortgage more affordable. It's something that's built into these mortgages. However, it's not an easy thing. It's not something that everybody can get automatically. That's changing now with after the 2008 financial crisis. Mortgage modifications became something that the government really pushed for mortgage companies to give to their clients. However, those old mortgage modifications were very cumbersome, they were difficult to obtain, and most people that apply for mortgage modifications did not get them. However, the new wave of foreclosures that are expected in 2021 and 2022 have caused the banks to, the government and the banks to create new systems and new mortgage modification programs that are basically much easier to get. They don't require documentation. They're more of a need-based system, not 100%, but it's much easier to get a loan modification now than it's ever been. However, the question that we're going to focus on in today's episode of Debt Law, Survival Guide for the Desperate Debtor, is a mortgage modification even a good idea? A lot of people are desperate for these things and they're not really sure why. It's almost like the new clothes, the new purse, the new car, whatever, people want it, but you're not really sure do you even need it. So we're going to talk about that. Maybe it is a good idea or maybe not. And we're going to focus on that, and we're going to talk about what you got to think about when you're looking at loan modifications and if it's even a good idea to get one. My name is Diego Mendez. I'm a loan modification, bankruptcy, and foreclosure lawyer here in Miami, Florida. I've represented thousands of people in loan modifications, either directly negotiating with the bank on their behalf or through bankruptcies or through foreclosure mediations. I've represented a lot of people in this, so I've seen a lot of this. I know what the banks talk about, I know what the banks think about, and I know what causes banks to say no and what causes banks to say yes. It's not an easy path, but I am focused on this in my program here, and what I want from you is to like my video and to not only like it, but also subscribe to my channel. Turn on the notifications so you get notified when I do a new episode. But even more than that, I want you to comment, because commenting about your experience getting loan modifications, dealing with the bank, is something that I like to hear, because I'm not on the front lines. I mean, I am supporting people on the front lines, but you're on the front lines. You're the ones who are going to get the letters. You're the ones who are getting the phone calls. You're the ones who decide, oh, I need to hire a lawyer or not, or whatever it is you're going to do. And I need information from you to know really what's going on, because what the government says is different than what actually happens in practice. We all know that. So we're dealing with a time of tremendous change right now. A lot of things are changing, and I very much appreciate that when you tell me things online that it's something that I like, because then I can then go research it and come up with new topics and new things to talk about here on my channel. So right now we're going to focus on loan modifications in about 10 seconds. So as I mentioned, after 2008, the banks came up with, and the government came up with a system called HARP, HAMP, had different acronyms. But basically, it was a system where people apply for loan modifications, and then sometimes they would get it, sometimes they didn't. The problem with these old loan modifications, number one, were that it involved a huge amount of paperwork, and they were very difficult to get. You would submit paperwork to the bank would deny you based on not receiving certain paperwork, and it would go back and forth for many, many, many months and years. I've had clients who were in foreclosure for 10, 12 years trying to get loan modifications. It's not impossible to get in those situations, but it's very difficult. Now we're dealing with a situation where the government has fixed that, I believe, because the new loan modification programs that they're offering, at least the government-backed mortgages, loan modifications, don't require any or very little documentation, which is very good, because the documentation is what kills people. Now, the question we're going to ask here is, everybody wants to pay less on the mortgage, but maybe the modification is not the way to do it. before you even think about loan modification, you should very much consider a refinance. Refinancing you can control many more of the factors that you can't control in loan modification. You can seek certain interest rates. You can ask for certain terms, 15-year, 30-year, and you can do things that you can get cash in some situations. None of those things you can do with loan modifications. Loan modifications are take it or leave it deals. Sometimes now the government has built in a reaction, a way to react, and a way to go back and say, well, no, I don't want to go to 40 years, I want to go to 30 years, that sort of thing. But you have a lot more power in a refinance than you can in loan modification. Loan modifications should be used as a last resort when you cannot actually pay your mortgage anymore, and you are able you must at that point ask for assistance. Now, the first question to ask yourself before you go down this path, before you start thinking about loan modifications, is do you qualify? I've done a few videos on this, and I'll keep talking about this, but it's much easier to qualify if you have a government-backed mortgage, which is if you have an FHA, a VA, a USDA, a Fannie Mae, or a Freddie Mac mortgage. These loan modifications, in most cases, not in all cases, are pretty much assured. So you need to, if you have one of these, it's not 100%. Nothing is 100% in life. Every circumstance is different, but these government agencies are giving loan modifications to people. But the question is, if you don't have a government-backed mortgage, then you really need to think about if you qualify. That's when the income verification might come in, and the old-style loan modifications are still being used by the non-government-backed entities. If you don't have one of these government-backed mortgages, you might run into problems when you apply. So that's the first question to ask yourself: do you qualify? Now, why do you want it? If you could afford the payment before the problem happened with your forbearance that caused your forbearance, you probably can still afford it now. So to go into a loan modification, if they're giving you an option to either put what you owe on the back end or to do something like that and keep your current mortgage payment the way it is, listen, that might be your best option, because we're going to talk about this in a second. You will end up paying a lot more in interest if you modify your loan. When you modify your loan, you restart the clock. If you're 10 years, 12 years, 15 years into your mortgage, you get a loan modification. What they do is take whatever you owe and extend it out into another 30-year mortgage. Sounds great, except that you're paying now on the lesser amount, but you're paying more interest over the life of the loan. If your desire is to pay off your house, then a loan modification does not get you closer to that. This is what this is. Are you okay with paying more interest? You will pay much more interest if you get a loan modification, because you start the clock over. The clock starts over, and then all of a sudden, what you thought, oh, I only have 15 years, and you start dreaming about retirement, that's gone, because now you got to restart your mortgage. This is a big deal. That's why loan modification should only be used, and also refinancing should only be used as a last ditch effort to save your home. If you can pay your mortgage payment, and they're offering you a $200-300 reduction and you're 15 years into your mortgage, getting a loan modification is not, in my opinion, the smartest thing to do unless you really need it. If you really cannot afford it and you really need this loan modification, then obviously you don't want to lose your house. But if you can afford it and you can keep making the payments, there's no need to restart the clock. Now, there's also a possible credit hit. Unless the bank specifically agrees not to list this loan modification as a loan modification on your to the credit bureaus, there will possibly be a credit hit. It might not be a big deal. It might be a few points, and you probably come back from it pretty quickly, especially if you keep paying your mortgage on time. But for some people, this is a very big deal. So it's something to think about. So what the bottom line is on this, on what we're talking about today, is first of all, you need to understand that loan modifications are a last ditch effort for you to save your home. If you're able to pay your mortgage the way it is, the way before you had got into forbearance, then there's really, in my opinion, no reason to go into a loan modification to save yourself a few bucks in the short term, which is going to cost you a lot of money in the long term. So really look at that, because to save $200 now, then to pay that over time in interest might those $200 will probably be that savings is gone. Now, remember also that escrow goes up every year, your taxes and insurance. So that $200 you're saving now is not going to be $200 in 2 years or 3 years. It's probably going to be much less. So if in 3 years you think you're going to be making the same amount of money, then why would you put yourself into loan modification? Again, it's you cannot afford your mortgage and you have no other options, and this is your option, then by all means, loan modification is the way to go. But if you have other options, then you might want to really consider taking the other options, because you will pay a lot more interest and you will, in the end, extend your mortgage out and be under the thumb of the bank for much longer than if you just kept paying your mortgage the way you're supposed to and you pay off your house in the term that you were initially agreed to. Again, my name is Diego Mendez. I've been assisting and representing and counseling loan modification clients for many, many years, about 13 years. And I've represented thousands of them in the situation that we're dealing with here. We are dealing with people who need assistance and they're trying to figure out how to do it. I've helped a lot of people do that. I have a working office here in Miami. I'm a working attorney, and I represent a lot of people in that. I also have this channel on YouTube, which is Debt Law, Survival Guide for the Desperate Debtor, and I very much want you to like my videos, subscribe to my channel, get the notification button, click it, but also leave comments, because I like comments. Comments really keep me fresh, and they help me understand what you're going through. You're on the front lines. You're the ones that are getting the calls and the messages from the banks, not me. I get people who hire me after the fact, but I don't really know 100% what's going on day by day. The day by day stuff is what we got to pay attention to, because everything that we're dealing with now is brand new. And these things that people thought, well, it was going to be very easy to come off forbearance, we're finding out that it's not that easy. Nothing in life is easy. We know that. So again, like, subscribe, notify, comment. My name is Diego Mendez, and I am here to try to assist you in any which way I can. Have a fantastic day. Until the next episode. Bye-bye.